So again, today we're going to pick up where we left off in the last class with the finishing up the economic conversion of the CFI and the economic profit tabs. So next statement we're going to talk about is cash flow available to investors, or CFI. So going back to this infographic, what's important is that cash flow is cash coming from the income statement minus the change in the investment in the balance sheet. Okay, so we're going to do this process 4 times, right, for each of the sections of CFI. All right, so it's cash from the income statement minus change in the balance sheet for operating. That'll be called free cash flow. For non-operating, we'll do that for debt. We'll do that for equity. Right, that's going to be a very important part of the statement conversion. Now, cash flow statement is the hardest statement to convert. The other thing is that I had mentioned that on the last class when we talked about TII, total income available to investors, that I thought that there was something amiss with the way taxes were being calculated. So I reached out to David Wessels and he sent me an email back, and basically I can paraphrase the quote, but he actually said, "Good man for catching that." He said that Tim Kohler, who's the worldwide head of global finance, decided to make an adjustment to the statement to make it easier for people to calculate, and therefore he said not everybody necessarily at McKinsey would do it the same way, but they actually did it for convenience to make it a little bit easier for people to calculate and understand. So I only say that because, as I said, as you go through some of these statements and some of these things in the real world, you'll see that people will do some things to make things easier. This is an example of a shortcut to try and make it easier for their corporate clients to actually calculate these statements. So theoretically, the way we originally talked about it is the way it's actually done at the theoretical level. They just made an adjustment in version 6 to try and make what they thought was a little bit easier. I actually think it makes it a little bit more confusing, difference of opinion, but nonetheless, that was the answer that we actually got from McKinsey in terms of the way they did the book. So with that in mind, what I want to do is I want to go back to and just say that we're going to do it slightly different than the book in version 6 and TII, just because I think it will help you as you go through the sections to keep everything clean. All right? So that's the process we're going to continue. So the answer you're going to see for CFI will look slightly different than the graphic that's in the book because of the way we're going to handle the taxes. All right? But regardless, we're going to follow a very similar process. So with that in mind, let's start with our CFI. So we create a tab called CFI, same periods, prior, current, and then the label, and then we'll start bringing things over. So again, your readings in the book for this week talked about free cash flow as the operating cash flow, and it defined it as gross cash flow minus gross investment, and they defined gross cash flow as no plat plus depreciation. Right? So that's the first thing we'll do. We'll take off of our TII, we'll take the no plat that we had calculated, and then we'll take from the income statement tab, which is where the data exists, we'll take the depreciation. And those are both ones. Now I'm going to add these two together, so I'm going to flip the sign because no plat plus depreciation, and that's going to get us something called gross cash flow. Right? And my gross cash flow is my no plat plus my depreciation. Okay? So again, this is just crazy accounting, but no plat is our operating profit after tax. Right? Our operating profit includes non-cash depreciation. The government allows us to deduct the depreciation as a cost of doing business, hence the no plat, but we have to add back the depreciation because it's really a non-cash expense if we're trying to get cash flow. All right, and this is just purely for tax reasons. Makes it a little bit more confusing, but that's the point. We subtract depreciation so we can get a lower number to calculate our tax base on. We add back the non-cash item because that was really a non-cash item that we subtracted. All right, so that's the idea of gross cash flow. So this is an approximation of the cash profit from the operations of the business. Okay, now the next piece is how much of it is reinvested, because the definition of free cash flow is profit after reinvestment. And so that's going to be gross investment. Okay, so again, we'll call this gross investment. And the formula for gross investment is change in invested capital, so equals, off the TFI, the current year invested capital minus the previous year invested capital plus the current year's depreciation. So in this case, it would be 80. Right? And free cash flow equals gross cash flow minus gross investment. Right? Now, this also becomes a preference because in this case, I'm subtracting a positive number. You could make investment a negative number and add it together, right? But I'm kind of following the format of the formula. So this is really just a preference, but my preference is the formula is gross cash flow minus gross investment. So I'm going to treat investment as a positive number, subtracting it from my gross cash flow to get a negative number, or sorry, to get a result for free cash flow. You could choose to add a negative number. So gross cash flow plus a negative gross investment get to the same answer. And that's just a matter of preference. And to be honest with you, I don't care which way you do it. To me, even though in the other statements we'll sometimes add negative numbers, is the way they did in the book, and that's fine, because it's just easier to use at sum. But the reason why I like to do it this way is because the formula itself is gross cash flow minus gross investment, and therefore it's just easier to think of it that way to me. But again, you could do it the other way if you want to make that a negative 80 and then add it. Okay. So the next question that's probably on your mind is, why did I add back depreciation? Okay. So this is what I like to call the shortcut formula for calculating gross investment, right? And this would match, by the way, back to the example in the textbook. If you go to the CFI tab, this would match the 150 here, right? Except what I'm going to do is I'm going to do this a little bit more granular. So I can either do it as the shortcut or I can do it more granular. So let's show the granular how we got to 80 of gross investment. So I'm going to add a few rows here. So I'm going to insert a few rows, and I'm going to go to my TFI, and the next thing I'm going to do is I'm going to rearrange my TFI. Okay? So when we did the operating, again, keyword here is operating, invested capital, right? We took all of the operating assets and we netted out all of the operating liabilities. Right? And that's a correct answer. And that gross investment is right. But this is the rearranging I'm going to do. I'm going to do what's called working capital or operating working capital, which are my current portion of the assets, versus long-term, which will be the net PP&E. I'm going to put them in the current and long-term format. Okay? So what I'm going to do is I'm going to take my net PP&E and I'm going to move it here. And I'm going to take my accounts payable and I'm going to move it here. And I'm going to basically call this operating working capital. And my operating working capital is my operating cash plus my inventory minus my accounts payable. And then my operating invested capital is my working capital plus my net PP&E. So again, I get the exact same invested capital, but here's the reason why I'm going to do this, is that when we start to do the valuation forecasts for the company, right, we're going to forecast investment. And one thing we could do is we could just forecast invested capital directly. But if you think about it, working capital is probably going to go up at a different rate than buildings, land, and equipment, right? Because a lot of companies, they build plants, and it's kind of lumpy. They don't build them every year. They might build it, wait a few years, and then build another one. Versus working capital, their inventory can be changing all the time. So therefore, for granularity, we will forecast working capital to grow at a different rate than net PP&E. Okay, so that's why I'm rearranging this so that when we eventually use this to then forecast, it will allow me to forecast them separately. So if you skip this step and you just had it the way we originally did it, added to the operating invested capital, you're going to get the right answer either way. Right? I'm just doing this to set up the forecastings. That's why I want you to wonder. That's why I'm doing a reshuffling here. So the original answer is correct. And by the way, for purposes of the midterm, I'm just going to ask you what your operating invested capital is. All right? So you don't have to get the working capital and the PP&E broken out for the midterm. After the midterm, you will, but for the midterm, you won't, and for your homework, you won't. Right? But nonetheless, that's why I'm doing this reshuffling to prepare us for the eventual forecast. Okay, questions about what I just did here? All right, so let's go back to the CFI. So let's just be a little more granular here. So one thing I could do is I could say, all right, what is my change in operating working capital? And my working capital went up, I think it did, from 80 to 90. So current year minus previous year. It went up by 10. Okay? So another way of saying this is I'm spending an additional $10 million or $10 in working capital. Okay? So that's the idea of working capital. Now, I'll give you another note. This is where Investopedia will fail you in this class. This is why you have to follow the process that's in the book, because the key here is operating working capital. So, for example, if we have excess cash, which you will have excess cash on your homework assignment, then that's not going to be part of working capital. So we're going to take the non-operating assets out of working capital, out of current assets when we calculate working capital. If you have short-term debt or current portion of long-term debt as a current liability, we're going to take that out of the current liabilities because anything that's interest-bearing is a 3. It's a debt equivalent. So it's not going to be part of working capital, current liabilities. It's going to be shifted to the debt side of the equation. All right? So you've probably previously learned current assets minus current liabilities equals working capital. All right? What we're doing is we're calculating operating working capital, which excludes non-operating items and which excludes interest-bearing items. Okay? So that's another adjustment that we would have made here. And it's very important that you follow this process in this class because, as I said, if you don't and you just follow standard conventions, you're not going to get the right capital number, right? Because you're going to mix the 1s, 2s, and 3s together in the working capital, and that's not the way that we're thinking about it. So that's why I'll call it operating working capital, right? But unfortunately, I'll start saying working capital even though I mean operating working capital. All right, so back to this. So that's the change in operating working capital. We're basically spending $10 million more in working capital than we did before. The next piece is the change in the net PP&E, change in the assets. And in accounting, change in net PP&E is driven by what's called capital expenditures, or CapEx for short. So it's not the change in the net PP&E, it's the capital expenditures. Okay? So here's the thing. I know that my change in net PP&E is going to be, move this over a little bit so we can easily see this, is going to be my beginning net PP&E balance plus capital expenditures minus depreciation would get me my ending net PP&E balance. All right, that's just accounting 101. So I start with some plant, I add the dollar value of the new plant, I take out the current year's depreciation, and then whatever's left will be my new net PP&E balance the following period. Okay, that's just how I would get from one period to the next, just math. So here's the point. What we're going to do is we're going to solve for capital expenditures, and that's the formula. So CapEx is going to equal my ending net PP&E minus my beginning net PP&E plus my depreciation. Just rearranging that algebraically. So that's what we're going to use to solve for CapEx. And you might say, gee, why are we solving for CapEx? Because on the GAAP statement of cash flow, the company gave us CapEx, right? In fact, if you go to the PowerPoint, here is CapEx listed on the accounting statement of cash flow, right? And here's the reason why. Is unfortunately, and I don't like what the accountants do, but increasingly what's now happening in the world of accounting is accountants are making adjustments to the balance sheet that never hit the income statement, right? So when I took accounting a long time ago, and we did T accounts and trial balances and stuff that I would love to forget, right? But basically when I took accounting, anything that we did had to hit both statements. You had the balance sheet, it flowed through the income statement to get to the next balance sheet. But now what's happening in accounting is we're just making direct adjustments to the balance sheet that are not hitting the income statement. and it affects, for example, capital expenditures. So then what the accounts will do is they'll write down the value of an asset, or they'll write off the asset that's been disposed as a direct write-off. They'll adjust the capital expenditures on the GAAP cash flow statement, but then they won't show an income statement adjustment. And here's why this becomes a problem, is that when we do the reconciled cash flows, our reconciled statement won't balance, right? Because the change in retained earnings won't get us to the actual equity because they'd written down the equity directly on the statement. And then what we'll have to do is we'll have to go through and figure out what adjustments they made, and we won't even know that they made an adjustment until we've done a lot of digging, and because our CFI won't balance, and it'll be maddening. And to be honest with you, where the bodies are now buried is the fourth statement that nobody pays any attention to. So where do they bury the bodies? Where do the accountants bury the bodies when they make these adjustments? What's the fourth statement called? You guys don't even know. That's the problem. What's it called?
Shareholders' equity.
Yeah, it's the statement of change in shareholders' equity. And that's where you have to find these adjustments. And very few people look there. And I think that's why the accountants like to put it there, because they know people don't look there. Right? But that's the problem, is it then gets this other fourth statement that we got to figure out. So we can go through that process, and we can take the CapEx, and we can figure out there's adjustments to CapEx, and then we have to make adjustments to equity to make our cash flow balance. Or, option B, solve for CapEx. Because I know that this is the only way the balance sheet balances, and I know that this would be CapEx with any adjustments to get the balance sheet to balance, so therefore we're going to solve for CapEx. That's the preferred method that we're actually going to use in this class. So if I know that the company doesn't make adjustments, I could use the CapEx off of the GAAP cash flow, but knowing that most companies do make adjustments, I'd rather just solve for CapEx and make my life a little bit easier. So that's why we're going to use this formula to help us solve for CapEx. Here's how we do it. So we go back to here. CapEx equals TFI, just found that formula, my current net PP&E minus my previous net PP&E, starting, plus current year's depreciation, 70. Change in working capital, 10. Change in CapEx, 70. 10 plus 70, 80. That's how I get to the 80. That's the granular way of getting there. These are both ones. Okay. By the way, change in working capital is ending minus beginning. CapEx is end minus beginning plus depreciation. When I add the two together, change in capital plus depreciation. That's why there was a plus depreciation in that shortcut formula, because it basically comes from the solving of the CapEx. That's where that formula on the right comes from. Questions? Because this can be confusing, and this is something you're going to have to do, but nonetheless, that's why we're solving for CapEx. All right, so second part of the statement, the non-operating cash flows. As I said, going back to our little infographic, same process. We're going to take the non-operating items from the income statement minus the change in the non-operating items in the balance sheet. Okay, just follow the same process. So, off of our income statement, which is now in our TII, we can see we had something called after-tax equity income. So again, equals TII, after-tax equity income. That's 2. That's the only non-operating item on the income statement. Then I go back to my balance sheet. Right? What do I have on my balance sheet? I have equity investments. So again, change. Balance sheet's all about change in equity investments. Right? Equals current year minus previous year. That's also non-operating. Right? And if I go back, if there's any other non-operating assets, I would have to add those in. If I had non-operating liabilities, just like working capital, I have to look at those. I don't have any. It's a little simple right now, but nonetheless, that will be the point. All my 2s, look for the changes, right? So I don't know how to tell you any other way to do this than the next step involves applying common sense. And I know you guys like to plug and pray, right, when you go through Excel. But basically, if you just plug and play or pray, as the case may be, you're probably not going to get the right answer, right? So this is where you have to apply common sense. So this is what I'm talking about. We're eventually trying to get to something called CFI, which stands for cash flow available to investors. And the idea is this is how much cash that I have that I can distribute to my investors. Okay, that's CFI. That's what it practically means. So as I go through line item by line item, what I have to do is I have to decide, does that add to the cash flow I have available to pay out to my investors, or does it take away from the cash flow that I would have to pay out to investors? Because that's going to determine the sign, whether it's a positive or a negative number. Okay, and this is what I mean by when you set up your statements, you got to really think this through. Right? Because there's not always a right answer the first time you set it up. Now, as long as you get consistent statements, and this will be the advantage of Bloomberg, because post-exam, when we do real-world companies, Bloomberg always reports companies in the same format. So once we map Bloomberg once, then it will work repeatedly. But if I pull out a 10K, right, and I'm looking at statements that aren't mapped, and the first time I map them, I got to look at the way the company's reporting the data, and I got to think about the cash flow implications. And so when you do your homework assignment and when you work on your exams, if you don't do that, you're really going to struggle with CFI. So in the past, I've had people that can complete this assignment that you're going to get in an hour, and I've had people complete it in 5 hours. In fact, the people in 5 hours just give up because they can't get it to balance, and then they just hate the assignment, and inevitably the hatred goes towards me. Okay? So here's how I don't want you to hate me. Right? So therefore, I'm going to tell you, the people that do it in 5 hours, what they do is they literally just randomly change numbers in their model until they hopefully get it to balance. And every now and then, they get lucky and they do, but sometimes they don't because there's just so many permutations that you actually can't get your model to balance, and then they just give up. Right? Don't be that person. Okay? I want you to be the person that gets it right the first time and knows why it's right. So here's the process. Think about CFI. CFI is the cash that I can pay out. Let's go back to free cash flow. If I have $150 of free cash flow, does that add to the CFI or does that take away from the CFI? What do you think? Can I pay out the $150? Or does that mean I need to borrow money? I have positive $150 of free cash flow. Is that going to add to the cash I can pay out or take away?
Can I add to it?
It's going to add to it. It should be common sense. Right? Sometimes it's okay to have common sense. Right? So, after-tax equity income. If I make after-tax profit on my equity investments, does that add to the cash that I can pay out or does that take away? It adds to the cash that I can pay out. Everybody see that? If my equity investments go from 15 to 25, which means I bought more shares in another company, does that add or take away to the cash that I can pay out?
Takes away.
Takes away. So, let's talk about signs. Should that be a positive 10 or a negative 10?
Negative.
If I'm going to add them together, then it needs to be a negative 10. If I'm going to subtract a positive, it's a positive, but I got to remember to subtract it. In this case, I'm going to switch it to a negative, and I'm going to sum them together. So I need to flip the sign here because it's actually going to reduce the cash flow that I have to pay out to investors. So my CFI is going to be the sum of these three things. It's going to be the free cash flow plus the after-tax equity income plus a negative 10 because I spent $10 million or $10 buying shares of other companies. My CFI will be 143. This is hopefully obvious, but if not, this is where people struggle. Because we're going to struggle, and that's what I said, there's no easy answer. You just got to think about the signs of the cash flows. Is it adding to my CFI? Is it taking away from my CFI? And that's usually what's going to get you the right answer, right? And if you think about it that way, you'll go through this assignment relatively quickly. If you don't, this is where you're going to struggle because you won't know why it's positive or negative or whether it should be positive or negative, and you're just randomly plugging in numbers. Okay? All right. So, assuming we have no questions about that, and assuming we have CFI, again, the key to CFI is just that. I have 143, call it million, $143 million of cash that I've generated from operating and non-operating activities that I can distribute to my investors. I need to create a balancing funds flow or financing flow, the second side of the statement, the threes and the fours, and I know that that number is eventually going to also equal 143. Right? It's going to balance. It's got to balance, otherwise I have a mistake in my statement. So here's the other key, and I mentioned this with TII. It's going to balance as in positive 143, not negative 143. It's not about absolute values, it's about actually balancing. So that number on the other side has to be 143. And so that's where I said this is where accounting is a little counterintuitive because it's not an accounting statement. Okay? In this statement, I have cash to distribute. The financing side of the statement is the distributions. Therefore, distributions are positive numbers on the financing side of the statement. That's the structure of this statement. I generate profit. I can pay the profit out. The payouts are positive because the profits are positive. Both sides have to match. I have losses. I have negative cash flow from operations. I have to fund those losses. Inflows, new borrowed money, are negative numbers on the financing side, funds flow side of the statement, the threes and fours. So I have to sync to what's happening up top. Okay? So, again, back to our process. Income statement minus change in the balance sheet. As I go to the debt section, the 3 section, I look on my income statement, TII, and I have something called after-tax interest expense. That is my only 3 on the income statement, and that is 15. So given everything I just said, should it be a positive 15 or a negative 15 on the cash flow statement? I paid $15 million of interest to my bondholders. Positive or negative?
Should be negative.
All right. If it's negative and both sides have to balance, I have negative here, which means the CFI, if there's nothing else in the CFI, would also be negative. And if the CFI were negative, that means I'm losing money. And if I'm losing money, could I actually pay it out? So can it really be negative? No, it can't be. So like I said, just think of it as the only line item. If my only line item were this interest payment, and if it were negative, okay, at negative 15, and the 2 sides of the statement have to equal, the other side of the statement would have to be negative 15, and that means I had negative cash flow. Well, that doesn't make any sense. I had positive cash flow. So the only way the statement's going to sync up is I had positive cash flow, I paid it out, the payout has to be a positive number, the after-tax interest expense is positive 15. So it's a positive 15. Payouts are positive. Just familiarity with the version of the statement and what it's trying to accomplish. Next, look at the balance sheet. Change in the debt. Any debt, I got to look at the change. So again, change in debt, interest-bearing debt. Well, that's off the TFI. My interest-bearing debt went from 225 to 200. So it went down by 25. On the CFI, should that be positive or negative? See, the good news is you have a 50-50 chance. And when you have like 20 items on the statement, you'll have a 50-50 chance 20 times. And that's what I mean by permutations. And this is how you go 5 hours. Until you get frustrated, and then you just give up. So like I said, we don't want to be that Rob Lowe. DirecTV commercials. Or Peyton Manning is the new one I saw in the football game. Anyways, positive or negative 25? Positive, because we're reducing the debt by $25 million. So I'd have to flip this sign. Okay, so again, I have $143 million of cash flow to pay out. I paid 15 to my interest. I paid 25 in principal. Now I go to the equity section. Equity is the toughest of the sections to do. There's 2 tricks to the equity. And if you don't follow these tricks, which are explained in the book, you will never get these statements to balance. Okay? So everything else has been relatively straightforward. Equity involves 2 tricks. Here's trick number 1. First, we go to the income statement part of equity, TII. The income statement part of equity is a 4. It's called net income. And I'll give you a hint. We don't use net income as the cash distribution to shareholders on the cash flow statement. Why not? If I'm doing the cash flow and interest expense is what's paid to the debt holders.
Net income's not necessarily what you pay out.
That's right. So what do you pay out?
You pay out dividends.
Correct. This is the trick. On the TII, to get my reshuffled income statement to balance, I reconcile with net income. But on the cash flow statement, I don't necessarily pay out that. What I pay out, the cash payout, is called a dividend. So this is trick number 1. The income statement impact on the cash flow is the dividends. Now the dividends were listed in the data tab as an assumption that come off the cash flow statement. The dividend was 103. On this statement, should that be a positive or a negative number?
Positive.
Positive, because it's a payout. Everybody see what we just did? Questions? All right. Then I go to the balance sheet, change in balance sheet, and I look at any change in equity items. Did I buy any shares back? Did I issue new stock? Any change in equity items? So in CFI, in our simple balance sheet, we have retained earnings. So change in retained earnings. And our retained earnings went from 170 to 265. They went up by 95. Positive or negative number on this statement? Our retained earnings, the equity that I have in the business went up. Positive or negative number? So it should be a negative number, right? Okay. So I'll make this negative. Right? And then as I look back here, that was my only 4 on this very simple balance sheet. Again, if I have other 4s, I have to look at those changes too, thinking about the impact of the cash flows. Once I've done all of this, I've now completed these sections, I sum these up, and I should get 143. And that would be a correct answer. The number I have on here is not a correct answer, and so therefore I made a mistake. What mistake did we make? Should it be negative 95? Well, let's be that Rob Lowe, and let's change it to positive 95. See what happens. Does that help? Should it be negative 25? Should it be positive 25? Let me keep track of all my permutations, so maybe I'll eventually get it to balance. And I'll tell you, if you go through that entire process, it's still not going to balance. What mistake did we make? Yes? Go ahead. It would balance if we put the actual net income in here. So the actual net income was 198 instead of the dividends. That's not a correct answer, though. Why? What's going on here? What really matters, because it had the wrong dividend number, where I have to put the dividends on there. So I can't replace dividends with retained earnings, dividends with net income, because net income is not a cash flow. Dividends are a cash flow. So there's your hint. Hint, hint. Dividends are a cash flow. Net income's not a cash flow. What's going on with retained earnings?
Retained.
Change in retained earnings, not a cash flow. So when I have a change in a non-cash account, it doesn't affect the cash flow statements. That's trick number 2. Retained earnings is not part of the CFI because retained earnings is a non-cash account. It's just a plug in the balance sheet to make the balance sheet balance. Okay, so just net income. It's not the cash that's actually distributed to the shareholders. Retained earnings is just a plug. Change in a plug doesn't affect cash flow. So that's trick number 2. Right? And that's what will frustrate you if you put a change in a non-cash account as an answer to your homework assignment. You'll never get your statements to balance. This is what I mean by applying common sense. So when you see a balance sheet account that you know is not cash, you can't look at that as something that's going to impact the cash flow. All right? And I'll give you a nice, simple hint. On your homework and on the midterm, the only non-cash account I'm going to give you is retained earnings. All right, so this is the only one you'll have to deal with. But nonetheless, if you leave retained earnings on here, you do a change of retained earnings, it will never balance. You'll never get a correct answer. Okay, questions about this? Okay, so here's the nice thing. I have a balancing statement. That's CFI. Right. Statement number 4. Save this along the way. It's called economic profit, or EP. McKinsey calls it economic profit. It's also known as economic value added. But the consulting firm Stern Stewart has trademarked economic value added, and technically nobody else is supposed to use it unless they pay Stern Stewart for the right to use it. So everybody else calls it something else. McKinsey calls it economic profit. So economic profit is EVA. Just because Stern Stewart is the trademark, they call it economic profit. Academics call it economic profit. Right? But basically it's the same thing. And again, you read this in the book. Economic profit's about the change in value, one period of time, economic value of an asset. That's all it is. Okay? And like every other statement, there's 2 ways to calculate it. So this is what I mean by balancing statements. We're going to have to balance the economic profit calculation. Okay? So what I'll do is I'll just take my, again, dates, my current years here. Now, method 1, you have to do both methods. It's called the spread method. Spread method is ROIC, is the first part of the spread method, minus the cost of capital. It's called spread. So I have to calculate my ROIC. To calculate my ROIC, I start out with, off the TII, my NOPLAT. And then I divide that by, off the TFI, my operating invested capital. And that gets me ROIC. So my NOPLAT is that. My invested capital is that. Divide, I get my ROIC. Now, I'm going to ask you to do something called BOY ROIC. BOY, also known as boy, stands for beginning of year. As opposed to EOY, which would be end of year. Okay? And this is going to be very important for you guys getting credit on the assignment. So, beginning of year ROIC equals current year NOPLAT divided by previous year's invested capital. Okay? So basically, the beginning of year invested capital, the January 1st invested capital, is pretty much the same as the December 31st invested capital, hence end of previous year. So the ROIC would be 55%. If I had done end of year ROIC equals current year NOPLAT divided by current year invested capital, I would get 48%. Right? If I ask you for boy ROIC and you say 47.73%, that's an incorrect answer. You'll get no credit. All right? Because that's based on the end of year capital. It's not based on the beginning of year capital, right? Matter of fact, there's a third convention out there where people do average capital, return on average capital. So take this year plus last year divided by 2. Okay? So my return on average ROIC equals current divided by that plus that divided by 2. And then, for order of operations sake, want that. So basically 51%. So that's the point. If I use average capital, it's 51. If I use end of year, it's 48. If I use beginning of year, it's 55. Right? There's reasons why you might want to use beginning versus end versus average. The reason why I'm going to tell you we're going to use beginning is an academic one. When you read the book, the chapter that was in the book reading, what it told you is that when you do enterprise DCF and when you do economic profit valuations, which are the two methodologies we're applying this semester, they're exactly identically equal if you use beginning of year ROIC. If you use end of year or average ROIC, you're close, but not equal. There'll be a rounding error. If you use beginning of year, there's no rounding error. You're exact to an infinite amount of decimal places. So when we do the valuations, to sync up the two valuations identically, we're going to practice using beginning of year. Right? Now, it doesn't mean for analytics we might not change later, but as we set up our model, I'm going to start out to show you that the two valuations will be identical. So you're going to be asked to calculate a BOI ROIC. Okay? So using BOI ROIC, what I then do is I would calculate a spread. So I will give you a cost of capital. So I'll make one up. We'll call it 10%. I'll give you this as an assumption. This is your cost of capital. So the spread is the difference between the ROIC and the WACC. So I'm doing 45.26% better than what I need to earn to satisfy my investors. So my economic profit for EP is the spread times the beginning of year invested capital. It's 172. So what this tells me with economic profit is I did 172, call it million, better than what was expected of me given the capital that investors gave me. So I created 172 million of value. Another way of saying the same thing, they expected me to make 10%. I made 55%. I did 45% better, and that created 172 million worth of value. That's economic profit, that's EVA. Method 2 to get the exact same answer. It's a very simple one. In dollars, NOPLAT dollars. So start out with my NOPLAT again. Minus something called a capital charge. I tied up $380 million. I needed to make 10% on that $380 million. Investors are going to charge me $38 million to use their capital. The difference between what I made and what I'm expected to make, the capital charge, is called economic profit. Equals 210 minus 38, 172. This is the second method to calculate the results. Both of them were explained in the book this week for the readings, actually last week's readings. Questions about what we just did with the economic profit? Hopefully pretty straightforward. All right, so the key here is going to be, back to this, when we do the valuations, there's two ways we're going to value a company. One, we're just going to forecast out their cash flows and discount them. It's kind of like an NPV, big NPV. Method two is this method. Economic profit is about a one-period change in value. Okay? So the idea here is we take our initial capital, we look at the change in value to the capital, and then what we do is we forecast the change in value. And the forecasted change in values plus the original capital equals the value of the company. Right? So it's just a different way to arrive at the share price. Method one, straight out value the cash flows. Method two, look at how much capital we've invested and whether we've added or subtracted to the value over time. Right? Think about this. Zero spread, zero economic profit, zero NPV. Right? Economic profit is just a one-period NPV. Right? Because think about that. If I have a 10% ROIC, I have a 10% cost of capital, I have no spread, I have no economic profit. So the asset's value didn't change. Right? I make enough of a profit to generate a 55% return on investment. I did 45% better than what people expected for that period. I created 172 worth of value. Okay? That's all economic profit is. It's just telling me, period by period, am I adding to the value or subtracting to the value if I did a one-period NPV? What is economic profit valuation? Just forecast it out and then discount it back to a present value. That's the change in value of the company. Add it to the initial investment. That's your valuation. That has to equal the same as the cash flows. Right? And that's the point. That's what we'll prove. If you use ROIC, when we do a DCF and we do this method of economic profit valuation, they will line up exactly. Right? By the way, that's part A of your final exam. I'll tell you today. Your midterm exam, part A, is here's an income statement, here's a balance sheet, convert it into these 4 tabs, get everything right, submit it, you're done. Final exam, here's a company, forecast out their cash flows, create a valuation, show me that the DCF and economic profit equal each other. That's your final exam. Okay? That's the theory that you got to understand. Right? And if you do, you'll have an easy time in this class. If you don't, you got 60 days to figure it out. Questions about any of this? Right? Because where we're going to go next week with this is with the analytics. Okay? Because what the analytics tell me, and this is very important, is back to CFI. This is a very important page. As technical as it looks, it tells you the 4 key things that happen at a company. Right? And if you'd sat through the Lockheed Martin investor relations presentation that we had in the last class, it's all about free cash flow. So here's the point. If I have free cash flow, in this case I do, I have free cash flow of 150. Then the question is, what do I do with the money? I generate more cash than I spend. Where do I deploy that cash flow? And ultimately, it's usually 3 major things. 1, I can put it in the bank, non-operating excess cash. 2, I can pay off the banks. I can pay off my debt. 3, I can buy back my stock or pay a dividend. Those are my choices. So those are the other 3 sections of the statement. So it kind of gives me a picture of what's happening with the company. So I generate free cash flow. What do I do with the cash flow? Or flip it around. I have negative cash flow. I'm spending more than I'm taking in. Where did the money come from? Did I raid my savings? Did I borrow new debt? Or did I issue more shares? So once this statement is done in the formatting, it can be very insightful as to what is happening to a company. Right? So here's a preview of next week. Okay? So if I go to, this is an example, I was doing an online MBA class this summer. Where was I? Here. So, where is this? In the online MBA class, one of the companies we looked at was called Chipotle. And this is an example of the valuation model that you guys will build from scratch in 3 weeks. It's got a bunch of tabs, lots of formulas. Don't be scared. It's not as bad as it looks. It'll only take us 2 weeks to build it. All right, so you don't know if I'm kidding or not. It will take us 2 weeks to build it. But once you build it, it's built, and it's reusable, and it's quick, and you'll actually keep using it. It's interesting. I have the people at the fund, the Sembit or whatever fund, that are taking this class before. They still use this model to help them with their stock screening and selection. And I got people that actually work for Wall Street banks that still use a version of this model to help them as they start doing the stuff that they work on Wall Street. So the model used in class is actually, this is a pro model. This is actually will work. And I'll show you that. This is Chipotle. But the point is, that aside, here's the CFI. And I'll hide some extraneous data, make it a little bit easier to see. But this is one of the analytics we'll do, which is I'll give you 5 years of history of a company on CFI, and it tells a story. Okay, so here's part of the story. In 2014, Chipotle had $296 million worth of free cash flow. Okay, they got expensive burritos. They generate positive cash flow. Now, you're not getting out of a Chipotle for spending less than $8 these days, right? So they're generating lots of cash profit from their income statement to the tune of $295 million, right? But here's what's interesting. Their cash flow available to investors are negative $29 million, okay? So the first thing I know is, what did they do with all this cash? Because they didn't give it to the shareholders. Where did it go, right? Well, one of the things I'll notice is that they put a lot of money into their savings account. They're holding on to the cash, right? So they're making the cash. They're just not distributing the cash. And they're also putting some cash into non-operating assets. I don't know what those non-operating assets are yet, but I know as an analyst 2 things. One, I know that there's no cash available to distribute to shareholders. And 2, I know that they're hoarding some cash, and they're also spending some money on some non-operating assets. So what are these non-operating assets? That's when I call the guy for investor relations and say, what are the non-operating assets? We'll just put the money in. Or on the conference call with the CFO, what's these non-operating assets? That's where the analysts will start getting questions for the call, but I at least know that question to do. Here's the next part. What happened on the financing side? That's the point. Pretty much all zeros. They did a little bit of a share issue, and they did a little bit of a share repurchase, but not much, okay? Because they didn't have a lot of cash to do it. So that's the point. They can't pay a big dividend because they're not paying dividends, and they're just putting all the cash in excess cash. I can see very clearly what's happening with the company over time. So just as a compare and contrast, if I were to look at another company, I don't know, when we did it this summer, we looked at McDonald's, another fast food company. Here is McDonald's, popping up on the screen. This is, by the way, next week. This is what you'll get into next week. CFI, and again, I'll hide the out years because we'll do a forecast. But look at McDonald's 2014. Now, McDonald's is a much bigger company. They generated free cash flow of $6.2 billion. That's a lot of cash flow. What did McDonald's do with it? Well, they actually had $7.4 billion to pay out. So I made $6.2 billion selling burgers, but I actually had $7.4 billion to pay out. So what did McDonald's do? Well, unlike Chipotle, they raided their piggy bank. They actually took money from their savings to distribute it to their investors. So opposite of Chipotle. So that immediately tells me something completely different about these 2 companies. Chipotle is growing, and they're using their cash, and they're putting in the bank as a rainy day fund. McDonald's, it's raining. They're actually not only taking all the cash they're making from the stores, they're taking even more and using it to distribute to their investors. They're taking their savings down. So again, immediately know this. I haven't even talked to them, and I've already seen this happen in the business. Next thing I know, what did they do with the $7 billion? Well, McDonald's actually negative 860 of debt. That's the number on there. If the debt says negative 860, what does that tell you about McDonald's? On the CFI. Think about signs, plus or minus. Negative 860. Did they issue debt or did they pay off the debt?
Issues debt.
They actually issued debt. Well, does that make any sense? They have $7.4 billion of cash to distribute, and they issued $860 million worth of debt last year. Why do you think they do that? Yeah.
Reduce their WACC, perhaps.
So they're playing around with their capital structure. They're probably taking advantage of all-time lows in interest rates and borrowing really cheaply. So what they do with all their cash? Well, they paid out $3.2 billion worth of dividends, and they bought back $3.2 billion worth of stock. Think about payout. I make $6.2 billion worth of free cash flow. I pay out to my shareholders $6.4 billion of distributed cash. That's McDonald's. Think about that versus Chipotle. Now, Chipotle's not as big, but Chipotle's generating a couple $100 million of cash, zero payout. Right? So this is an example of a mature firm versus a growth firm. With a growth firm, I'm not looking for dividends. Chipotle is doing really well. I expect them to open more stores. I expect them to reinvest. And to be honest with you, having some extra money to help them do more reinvestment, I'm not worried about because of where they are in their life cycle. And I'm willing to wait. McDonald's, they're having same-store sales problems. People have viewed them as an unhealthy company. They're having all sorts of problems. So what is McDonald's doing? They're not opening a lot of new stores. What they're really doing is they're just taking all their cash, they're giving it back. Right? It was funny. I was at a conference on Friday with Lyondell Basell, and their second largest shareholder, Fidelity, was there. And the guy that actually manages one of the funds at Fidelity that owns them was talking to them. And he said, one of the things that I do my own analysis, as I'm paraphrasing, I do my own analysis on companies. And even when I don't like a company, he said, basically, at the end of the day, it's about cash. And he says, what some companies will do is they'll just stuff the cash down your throat until you just choke on it. He's like, choke on this cash. And they'll eventually, even if I hate the company, I'm choking on so much cash that I decide to like them. Well, that's McDonald's. You're just going to choke on this damn cash. We're going to put $6 billion down your damn throats, and you're going to just like it, and then you're going to buy our stock. And that's where we get the analysts to like McDonald's. So far, it hasn't worked. Okay? Because they sell beef, right? Not beef, they sell beef. And beef is a problem long term, because beef is perceived as unhealthy. And so they have a consumer problem, so people are not going to McDonald's, but they're trying to make up for it by feeding investors cash, right? And they're hoping with this $6 billion, they're going to keep paying out all that free cash flow, that eventually investors will like them again, right? But that's the point. I can see that. I can see that's in their strategy. Where Chipotle is like, we're not going to give you any cash because we got you addicted on our burritos. You're going to come, you're going to have even more burritos. And we're going to sell you even more burritos. Then we're going to sell you a burrito bowl. And we're going to sell you a burrito salad, right? You're going to make a lot of money by selling more burritos. So I'm just telling you, the story of the business starts with the cash flow, right? Obviously, the operations matter, but there's a lot that's going on here once we put in this format. So this is next week. This week is how do we get to this point, right? That's going to be your homework assignment. Questions? All right, so back to this. One last thing. So I'll do this with the MBAs. So here was the midterm exam. Actually, was this the midterm exam? I don't remember. Here's a practice midterm that I gave the MBAs, which is very similar to your homework assignment for today. So what's going to happen in your homework assignment for today, just throw it up here, is that we just went through the conversion of the statements. The statements for your homework and the statements of the midterm are going to look a lot more like this. So you'll notice that the income statement is going to have a lot more categories. And then the balance sheet, that's the assets, that's the liabilities, a lot more categories. So what's important, and it was funny because I was actually thinking about doing it this semester, but I just got lazy, is I was actually thinking about doing the assignment where I took off all of the names and just gave you labels. So basically, I was going to just give you like balance sheet item blank, call it a 4. Right? Balance sheet item was going to be blank, call it a 3. And not tell you what it was. Because you can actually do the statements that way. And that's what I said, the labels matter. So the good news for you is in your homework and on the midterms, I'm going to give you the labels. And I'm going to still give you the terms. You'll still see the names of what the columns are. So, couple of words of warning. Number one, I'm going to change the tax rate on you constantly. So it won't be 25% like it was in the example. Here it was 20%. I'm going to change the cost of capital. So it won't be 10%. Here it happened to be 7. So every time I give an assignment, I'm going to keep changing it. So just remember that you have to look at the assumptions that you're presented with, or it can really be really, really bad for your grade. Now, back to this. There's a few categories on here that you might want to be aware of as you're going through the homework assignment. One, you'll see it on here, it's called excess cash. Okay, so I mentioned this before on Monday, but I'm going to mention it again today, that I'm going to distinguish between operating cash and excess cash, right? And the key to both is operating cash is a 1, it's going to be part of operating working capital. Excess cash is a 2, it's going to be part of non-operating assets, okay? And the question for you is, how do I handle it on my CFI? Okay, how do I handle excess cash on my CFI? All right, and here's the metaphor that will hopefully help you as you try and come up with the proper sign. So in my personal life, my checking account is at Bank of America, and I also have a Fidelity account, which I use to trade some stocks for fun. Okay, well, hopefully for profit, but don't always make money. So here's the point. That's all I do with my Fidelity account. There's no bill pay or anything else out there. It's kind of like a savings account where I'm just putting some money to work at the stock market. So I take money from my checking account, which is used to pay bills and run my daily life, and I send it to Fidelity electronically so I can go buy stock in whatever company I want to buy it. Okay? So does that add to my CFI, or does that take away from my CFI? So if I increase the money of excess cash in my Fidelity account so I can buy more stocks, does that add to what I can pay to my investors, or does that take away from what I can pay to my investors? Takes away. Okay, so think about the cash flow impact on that. If I'm increasing my excess cash, I'm reducing my CFI because I just don't have money in the checking account to pay out anymore. I send it to Fidelity. If I sell stock in Fidelity and I transfer it back to Bank of America, then do I have more cash to pay out to investors? Yes? So that will add to my CFI. Okay? So that's your big hint directionally as to how you're going to handle change in excess cash on the CFI. Okay? Now, the other thing that you're probably going to struggle with is something called, well, 2 things. 1, treasury stock. What is treasury stock? Yeah. Correct. So it's a share repurchase. And under accounting rules, it's called a contra account. Right? So it's a reduction of equity. So when the company goes from 250 to negative 250 to negative 375, this means they're buying back their shares. Okay? And it's the dollar value of what's been bought back. On the CFI, is a share repurchase a positive number or a negative number on the CFI? Yes, because it's payout will be a positive number. All right, here's the final one you may or may not be aware of, something called minority interest. Okay, minority interest shows up on both the income statement and minority interest shows up in the balance sheet, and that has to do with accounting. So here's the way the accounting works. Let's say you and I have a joint venture together, but I own 51% and you own 49%. Okay, so the way it's going to work is your 49% ownership in my joint venture on your balance sheet will be called an equity investment. Okay, so for him, if he owns 49% of our combined company, it's an equity investment that's non-operating that he will get equity income on. Okay, for me, under accounting rules, if I control the company, which means I own more than 50%, then the accountants say I have to treat our joint venture as if I owned 100% of it. And I take our joint venture and I throw it in with the rest of I do, and I take all of the revenue from a joint venture and I claim it. I take all of the profits from the joint venture and I claim it. I take all of the assets from the joint venture and I claim it. Right? I then pay the taxes on the profits of our joint venture. Then what happens is after I pay the taxes on his 49% of the profits that I've claimed, I give him a distribution. An after-tax distribution, kind of like a dividend. That is minority interest on the income statement. That is a payment to the minority shareholders for the business that I am saying I'm taking 100% of the financial responsibility for. So I report the profits, I pay the taxes, I then distribute a share of the profits after tax to the minority shareholder. Is that to him on my CFI, payment to minority shareholder, is that a positive or a negative number in the CFI? As a financing flow. It's kind of like a dividend. It's a positive number because it's an outflow from the business. The other thing I have to do is I told him he owns 49%. I got to keep track of the fact that he owns 49% of the joint venture, which I'm taking 100% of the assets. So on my balance sheet, I have the equivalent of a liability to him of the original amount of equity that I'm saying is part of my business. Now, he's not a common shareholder, and he's not entitled to all of my business. He's only entitled to the ownership stake for the part of the business that I have absorbed. That's minority interest in the balance sheet. So on his business, his 49% represents an equity investment, which is an asset. On my balance sheet as the company that absorbed the joint venture, I represent his 49% as a minority interest on the equity side. It's kind of like a liability to the shareholder. And so there's an equity stake on the balance sheet called minority interest. So there's two parts of minority interest. The equity of the minority shareholder on the balance sheet, the distribution of cash dividends after I pay the taxes, so I don't tax affect them, to the minority shareholder that I have made. All right? That is something you'll be dealing with on your homework assignment. Hopefully that explanation helps you as you go through this. This is also talked about in the book chapters. So, by 10 a.m. on Monday, your assignment is due. After 5 o'clock today, I'll post the financials that you'll have to convert. Just so you know, for next week, I'm flipping it. Monday is going to be a Bloomberg Lab Day. So you have a Bloomberg assignment to start doing some of the analysis that I showed you on Chipotle and McDonald's. Wednesday will be our next lecture next week. Okay? So next Wednesday is the lecture. Monday is the Bloomberg Lab. Monday is the day the next homework assignment of the converted statements due. Okay? See everybody for the lecture on Wednesday, Bloomberg Lab on Monday. All right? I'm going to post this to YouTube in just a few minutes.